Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today what we are going over is how much can you withdraw from your retirement portfolio. And trying to do research from how much you need to retire, there are all different types of articles out there recommending all different withdrawals amounts, the amount of dollar amounts that you need in your portfolio, and typically what I hear is the standard 4% withdrawal rate. So in my opinion in this video, we'll be going over a lot of different things. We'll be going over, is the 4% rule a traditional rule that you should probably follow, and should you be taking out a fixed percentage? Should you be taking out 4% of your portfolio no matter what it's at, or should you be taking out a fixed dollar amount from what you need to live on? We're going to go over how you should be protecting yourself in market crashes. This is important for all investors, not just retired, but growing investors as well. And then how you should always look to touch the eggs laid from the goose, but not the actual goose itself. So basically what that means in layman's terms, be touching what your portfolio produces and not what it's actually worth. Does that make sense? Touch the interest, not the principal. And what we'll be showing in this video is lots of different examples with dividend stocks with bonds, S&P 500 with bonds, and the S&P 500 just by itself, as well as some other portfolio examples as well through different timelines. So it's going to be a fun one. So thank you guys for tuning in. If you're not familiar with me, my name is Jordan. I'm the Millennial Investor. I track my annual and monthly dividend income from these 25 different companies that I have listed on the left through these annual charts right here. And I also track my portfolio and monthly YouTube income as well. And if you're new to the channel, I would invite you to subscribe. You can follow along with me and watch me invest in this portfolio every single week. And I update you guys on everything in my portfolio, from buys, sells, dividends, everything you could possibly imagine. And we now have 59 people signed up. So go ahead and get that number to number 60. Go ahead and copy this link that is down below in the description, and you can get $10 just for signing up and depositing $100, as well as other things down below in the description as well, including my pie if you want to invest in it yourself or just see what I have invested in, and other things as well like auto savings accounts, credit card referrals, and all that stuff. But thank you guys for tuning in, and let's go ahead and get started with this email that I wrote out right here. You should start out with going a fixed dollar amount instead of a fixed percentage, and I will tell you why. It's mainly due to these three bullet points. I don't know why I wrote two twice. These three bullet points right here. Using a percentage would mean living on less in a downturn. So you see these two portfolios. So what I did, I'm going to be showing you guys some different timelines. And before I get into that and withdrawal rates and all that stuff, what I want to show you is that this is the S&P 500 and a group of dividend stocks that I picked from my portfolio, just a bunch of dividend aristocrats that have been around for a long time with a great track record. And look at the fluctuation in prices. I'll just give you an example. If you started with $1 million back in 1995, and you kept that invested and you retired all the way until the end here in 2020, the main part to focus on here is from January till March of 2020. At the beginning of January in your S&P 500 portfolio, you would have had 5.8 million and then had a downturn all the way to 4.7. That's a $600,000 downturn in the matter of 60 days. That is a huge downturn. And the same thing with 2008, 2009. You're looking at the S&P at the end of 2007 at 2.8 million. Then it turns all the way down to get cut in half at 1.3. You're looking at over $1 million downturn. So if you're in retirement and you're relying off that income, that's not something that you want to focus on. You would have a rapidly fluctuating income, and that is not ideal for retirement. You don't need 1 year to live off 50,000, the next year to live off 100, the next year to live off 20,000. You do not want that kind of income. So the third step is to figure out what exactly you need. So in your retirement, you need to figure out what you need to live on. So I'll just give an example real quick. I want to show an example of $50,000 a year. Now, a lot of people, some people can afford $50,000 a year. Some people afford on much less, myself included. And you can change the numbers according to how your annual expenses are. So for example, with this $50,000 income, what you do is you divide your annual expenses by your withdrawal rate. And I'll get to withdrawal rate in just a second. But if you think with your portfolio, you would only feel comfortable taking 1% out. Then you divide 50,000 by 0.01 and you would need 5 million. At a 2% rate, you need 2.5 million. At a 3% rate, you need 1.66. At the 4% withdrawal rate, which is what a lot of people recommend, you would need $1.25 million. At a 5% withdrawal rate, you would need $1 million. And then last but not least, at a 6% draw rate, you would need $833,000. If you want to see further than that, I wouldn't really recommend anything past a 6% withdrawal rate, because once you get over those numbers, you're starting to get pretty risky. But my opinion is to have a portfolio big enough to have your comfortable withdrawal rate plus 1 year of expenses. And I'm about to show you why that is so important. So what we're going to do is we're going to go in 5-year increments of my dividend stocks that I chose and comparing that to the traditional S&P 500. Because you might be using dividend stocks, you might be using the S&P, just the basic average S&P 500 investment, but we're going to look at a 5-year period. And these are the 10 companies that I chose, all at an equal 10% rating. I chose Home Depot, Realty Income, Johnson & Johnson, Kimberly-Clark, JP Morgan Chase, Caterpillar, Pepsi, Coca-Cola, McDonald's, and Procter & Gamble. 10 companies that are all diversified between different sectors and companies that have an extremely long track record. So what we did, we started with a $1 million portfolio, withdrawing $5,000 a month, i.e. $60,000 a year, which is a 6% withdrawal rate. This is just an example. And let's go ahead and go to 5 years ago, and we're going to keep on going in 5-year increments. This is not adjusting for inflation, not rebalanced, and let's go ahead and update this. Let's go ahead and look at from the last 5 years. In these two portfolios, they would have uptrended. You know, the stock market's been up the last 5 years, and you would have had about a similar performance. The portfolio with the dividend stocks slightly outperformed, but pretty close. But meanwhile, what's more important here is that your retirement is safe. During the little dip here in 2020, you would have went right back down to about your $1 million mark with the S&P 500, but you're still safe. You're still good. So let's go back another 5 years, okay? During 2010, we hadn't had a recession yet. We're just coming out of the economic recession of 2008, 2009, and let's see that the portfolios take off here. You're doing just fine. But let's look at a different scenario here. Let's look at 2005 and 2000. So if we go back to 2005, this is between the dot-com bubble and the financial crisis of 2008, 2009. And this is where it starts to get interesting. When you start withdrawing in 2005, a couple years before a huge recession, your portfolio starts with $1 million, and during the downturn, it goes down to $507,000 with the S&P 500, okay? It dips down to only $720 with the dividend stocks because you're not taking out as many shares. You're living off a large amount of that cash flow. Now let's go further, and let's go all the way to 15 years later, to the end of 2020. You end up with $1.5 million. You're still safe, but things got a little hairy here at the bottom of 2009. Now let's go ahead and look at the example with 2000. This is where things get interesting. So this is why I recommend saving up an additional year's worth of expenses, and this is why this is so key, and this will demonstrate this perfectly. If you started investing $1 million even and withdrew $5,000 every single month like clockwork, and you had two portfolios, you had one investing in the dividend stocks that I recommended and the other one investing in the S&P, the dividend stocks would be doing great. The dividend stocks would be in the millions of dollars. They would get right through the dot-com crash. They would go down a little bit, recover. They would get through the economic recession of 2008, 2009, and they would go down a little bit and they'd recover. And then all the way back here in 2020, you've almost doubled your portfolio. But if you notice that this portfolio only goes to 2016, and that's because in the year 2016, you would have $0 to your name. If you started with 2000 during the dot-com bubble, your portfolio would have went down and down and down for the next 2 or 3 years like the S&P 500 did, and by the time it started to recover, you only have about 500,000. So it's staying steady at this 500,000 mark, and then the financial crisis of 2008 happened. Look at this downturn. It would have took you all the way down to 208,000. And by the time you get down to 208,000, we're back in a roaring bull market. The stock market recovered at dramatic levels, and it would have been the best buying opportunity ever. Except there's one problem. You're not buying in this stock market. You're withdrawing. You're retired. And your stock portfolio never would have came back. And even as we got to 2016, you actually would have outpaced your retirement. You would have $0 to your name. So if you would have outlived this to 2016, you would have $0 and no retirement whatsoever. Now that is a crazy thought. This is why it is so important to do what I'm recommending here in my email. My opinion is to have a portfolio big enough to have your comfortable withdrawal rate plus 1 year expenses. During this downturn, let's go back to 2008, 2009. Let's go ahead and start this portfolio. So let's say 2007, okay? If you're withdrawing out of the S&P 500 in 2007, you would have barely recovered over the course of these 13 years. All right, you would have been right about where you started. But during this year period where everything is at rock bottom, if you could have avoided withdrawing right here when it mattered most, you would be right back up here where these dividend portfolio stocks are. Now this is once again, one thing I haven't mentioned is that through all these scenarios, even go all the way back to 2000, in the worst case scenario, these dividend stocks did just fine. Your portfolio at its lowest point would have went to 711,000 and then shot right back up sky high levels. Just one more reason why I think dividend stocks are superior to all other methods of investing, but that's besides the point. But the reason why this is so important is I want to give you an example of a $50,000 salary like the one we showed up here, and you're starting with a $1 million portfolio. Do not start the withdrawals until the portfolio reaches $1,050,000, i.e. the $1 million plus your $50,000 salary. Take the $50,000 on cash and put it on the sidelines for the inevitable market crashes, okay? And then steady withdraw the $50,000 a year, like we showed in this example, steady withdraw the $50,000 a year, and then during these periods, in the bottom of 2002, 2003, and the bottom of 2008, 2009, use the $50,000 cash to live on. Use the cash instead of using your portfolio so you do not get wiped out. And there's many examples of this, but pretty much any downturn in the market, from examples with 2001, 2002, 2008, 2009, and then the beginning of 2020, and then so on and so forth, whatever crashes we have on in the future. So now I know what I need, and now what? Do I own stocks, bonds, both? And then I have this portfolio that I showed at the beginning of the video. We have 4 examples here. Dividend stocks with bonds, S&P 500 with bonds, and then just a traditional S&P 500. I have these examples going all the way back to 2003, and I'll get to that in just a second. You need to own stocks for growth and to outpace inflation. You want to own stocks so that way, 1, your wealth can increase. You will get wealthier and wealthier every single year. And more importantly, this big word, the last word right here I'm highlighting, inflation. Your annual expenses will go up by about 2% every year. So if you're not making at least 2% on your money on top of what you're withdrawing, then you're not going to be able to have a sustainable retirement over the course of 10, 20, 30 years. And then the second one, you need to own bonds for portfolio stability, okay? So that way your portfolio is not as volatile as the one we showed right here. So that way in a downturn, you don't get wiped out as easily. And that way you also always have a safety net. So that way, for example, let's say there was a 1929, a Great Depression, okay? If you own even 10% or 20% of your portfolio in bonds, things would dramatically change. You would not be nearly as wiped out as you would have with just all equities. Now, my recommendation, depending on market environment, is that you should traditionally have about 60 to 95% of your portfolio in equities because you need a lot of growth, even in retirement. And then bonds should make up, once again, depending on the market environment, about 5 to 40% of your portfolio. Now, in today's market, in a, quote, yieldless environment, you have interest rates at literally 0%. Bonds are the worst investment you could possibly do right now. So in today's market, I would do about 5 to 10% in bonds, no more. Now we have my retired dividend growth investing portfolio for 2021. If you're someone who is retiring right now or very close to it, this is what I would recommend. A 90% high quality dividend stock portfolio, i.e. my portfolio, and then have 5% in corporate bonds. The reason you want this is for stability. Now I know the returns won't be great and bonds are not that attractive right now, but God forbid in the worst case scenario, you at least have 5% that's pretty stable, pretty safe. And then last but not least, you have another 5% in treasury bonds. That is for your safety net as well as some more stability in your portfolio, but 90% of it is still growing at a rapid pace. Now let's go to my portfolio. The dividend stocks that I recommend are high quality dividend stocks. And pretty much any out of the list of these 25 stocks are ones that I recommend. I'll just scroll through real quick if you just want to see the 25 that I own if you haven't seen it before. And there you go. There's the 25 companies that I own, and these are great for someone that is wanting to retire, especially the higher yielders like WP Carey, Realty Income, Broadcom, Southern Company. A lot of my main holdings are very high yield but safe quality dividend stocks. Now let's go ahead and go to the example. I went ahead and drew up some examples for you guys just so you can see an idea of how these different opportunities work in the market. Now real quick, I just want to mention, I probably should have mentioned this earlier. If you want to plug in these numbers yourself, go ahead and go to Portfolio Visualizer. This is a website that I absolutely love to mess with. It is great for these types of examples. Now we're starting with $1 million, once again, during our 6% withdrawal rate, a $5,000 withdrawal rate. This is having no emergency fund on the side and just using your portfolio. I want to show some different examples. Actually, let's go ahead and show 2,000. Let's use the bad example, okay? And what I did is I took my 10 stocks that I did in the previous example and I used 10% for Portfolio 1. The name of Portfolio 1 is just dividend stocks. I took Home Depot, Realty Income, Johnson & Johnson, Kimberly-Clark, JPMorgan Chase, Caterpillar, Pepsi, Coca-Cola, McDonald's, Procter & Gamble, and I gave them each a 10% weighting. Just stocks, all equities, no bonds whatsoever. In the next example, in Portfolio 2, I just had these 10 dividend stocks, and instead of weighting them at 10%, I all took 2% away from them and took that 20% and put it all into treasury bonds, for example, okay? TLT, this is a treasury bond example, and I put 20% in that. And in the third example, I did 80% S&P 500, no dividend stock, just a traditional S&P, with 20% of it being in TLT, the long-term treasury bonds. And then I also put a specified ticker for the benchmark, just the S&P 500 by itself. And let's go ahead and calculate this. Now remember, this is during the year 2000 when things are horrible. This is one of the worst times to retire because you have back-to-back recessions. By the way, I forgot to mention TLT, the Treasury Bond ETF, only goes back to 2003. So let's show a bad time, for example. Let's say you're retiring in 2007, okay? And 2007 was a horrible time to retire because of the recession. And let's look at how these portfolios did. I'll show an example further out in just a second. If you were to retire in 2007, if you see the downturn here at the beginning of 2009, you would have had your portfolio cut in half with just the S&P, and if you had some bonds in there, it would have been a little bit better. If you had dividend stocks with bonds, that was the best performer because that is the most safe of these, and then the dividend stocks would have been second place, just a little bit higher than that of the other two. And then if we go further, let's scroll all the way to the end. Do you notice something here? During this downturn in 2020, you have the S&P that is still not recovered. It is still the laggard behind this. The S&P 500 with bonds does get hit, but you're still at about your $1 million portfolio, and it does recover quite nicely. Now, if you look at the other two up there, look at the dividend stocks with bonds, you see almost an exact performance of that and with just dividend stocks. And that is because when the market inevitably downturns, that's how you're protected. The red line is the one that I like the most, but the blue line is also good as well. This is why I like dividend stocks, just one more example. And at the end of the day, you see the four performers. The dividend stocks are number one, dividend stocks with bonds number two, S&P with bonds number three, and just S&P number four. Now let's show one final example. If you go further out, let's look at some more realistic scenarios when you're not retiring at the top of a recession, okay? Let's go back all the way as far back as it'll go. I think the TLT goes back to 2003. Is that what it is? Yeah, so January 2003. This is the timeline. So if you go back to about the middle of the market, this is after the dot-com bubble. This is a couple years before the recession, so you have a lot more growth here. And this is how your portfolio will look over the course of that 2003 to 2020 period. And you can go ahead and plug in these numbers yourself. Like I said, if you want to see these portfolios, if you want to change some of the holdings around, the percentages, the withdrawal rates, and this is why I recommend using a fixed dollar amount because, hey, at these levels, once you get well past that $1 million mark, once you start getting to the 1.5, the $2 million, the $3 million mark, if you want to withdraw more, you do not have to stay with that traditional $50,000 withdrawal rate. And as again, you're outpacing inflation by about a mile. So thank you guys for watching all the way to the end. I really appreciate it. I invite you to subscribe so you can watch me update these every single month. And go ahead and sign up for M1 Finance if you have not already. It's a great platform. I definitely recommend it. And help me go ahead and get to 60 successful referrals. I'd really appreciate it. But thank you guys so much, and I'll catch you guys next time.